going to be the trade-off for banks when they're setting the loan rate. If they increase the loan rate, they participate more in the upside risk, so that they don't just cut off their risk at this loan rate. They're going to get a higher payoff, right? But they're going to have a lower portion of entrepreneurs who can make that threshold, right? Increasing the loan rate will also increase the threshold productivity. So there's an optimal internal loan rate and hence threshold productivity, and it's going to maximize the expected return here for a bank. With aggregate risk, right, we're going to see that this loan rate has to adjust based on economic conditions. Right, so if the average rate of return turns out to be lower than expected, right, then we're going to have this risk is going to be passed on to entrepreneurs, right, with a higher loan payment in the non-default state. So a loan rate increasing if this average return turns out to be lower than expected. All right, so what we find then is that then as the macroeconomic conditions deteriorate, then both this probability of default and the risky rate are going to increase. They're going to be counter-cyclical. All right, now how about for an individual entrepreneur? An individual entrepreneur, J, right, is going to choose how much capital it wants. This implicitly then also determines how much it's going to borrow. We have a fixed net worth. So what's the expected return? Well, now the entrepreneur will get the upside risk. Right, so look at the expected return right above the threshold. Right, so an expectation beforehand, right? This is an average conditional on omega being above the threshold. Right, and what are their costs is the loan payment. We go back here. It is 1 minus CDF of so it's this mass above. And so it's this whole mass here times what is this expression here? Well, that's based on here. That's just what we pay back if we don't default. So think about it, the entrepreneur only makes a payout, only makes a profit if it doesn't default. If it does default, its profit is zero. Remember, the entire downside risk gets put on the bank. So we also have an incentive problem here if I'm an entrepreneur. If I borrow money, right, and I go to gamble in Macau and I make a huge amount, I can take that home with me. If I gamble and I lose, I don't lose anything. So if I gamble and lose, right, I owe you, say I borrow $1 from you, and I go to Macau, and I lose that dollar. Right, so now I owe you $1. Would be better, actually, can you send me some more money? I'm in Macau now, I need another $1. Why? Because if I borrow that other $1 and I get the jackpot, then I can pay you back the $2 that I now owe you in total, and I'll have the winnings that I get on top of that are above and beyond that. If I lose the second time, I'm still going to end up with 0. I'm not any worse gambling another time. If I gamble and I lose, I need another euro, another $1, another $1, and I'm going to keep gambling until I get into that upper part of the distribution, right? Until I hit the jackpot. Right? That's this is the risk of this asymmetric information. If you have an unlimited credit, right, that you don't have to pay back, if you default, well then I'll just keep borrowing. There's no difference between losing €1, right, and losing 1,000 euros or 1,000,000 euros. Right? If I go bankrupt, I have nothing. I don't have really bad bankruptcy. Right? I end up with $0. I can't end up with minus $1,000 or minus $1,000,000. Right? So it doesn't matter how big my loss is. Once I make a loss, I get nothing. Which means our entrepreneur is only looking at the upside situation. Now what happens if we choose a lot of capital? Well, we're going to have to pay a lot back. Right? So if I borrow $1 to pay back $1, sugar Macau, it ends up being 3, I have to pay back 3. So the more dollars I borrow, right, the more I'm going to pay back. But right, the more dollars I borrow, the more capital I raise, right, the larger then is the upside if I'm above this threshold. Right, we can combine expression 3 and 5. Let's take the right-hand side here. What do we have here? This is the I just solve this, so I have then the opportunity cost for the bank. This is what the bank has to pay its depositors, or what the bank could earn right, from the borrowings on the market, minus what the bank is able to recover in a default setting. All right, so think of it differently. So our return as an entrepreneur is the upside of the investment minus the opportunity cost of the bank, corrected for what the bank is going to collect in the default state. So in essence, right, we're having to pay the bank, we're paying the bank, compensating the bank for its outside option and for our default risk. We are the ones paying for it as an entrepreneur. We can separate these terms out a little bit. Right? We see here we have then the total, right? We have the downside and the upside risk. Right? We don't keep all of that, right? We deduct from that these bankruptcy, these monitoring costs. We end up paying that. That's deducted from our expected return. So we don't get the expected return from our investment minus the banker's outside option because we borrowed. We get the entire expected return from our investment minus the monitoring costs and minus the banker's outside option. All right, we can then rewrite this as this whole term here is the expected return of the investment terms. Yeah, yeah. So you should see here is that explicitly in this term here, what we're paying back to the bank are already these default costs, this downside risk, are encapsulated in that. We are the ones who are paying that as entrepreneurs. We're going to be paying for it by these higher costs, marginal costs, these lending costs. All right. Our entrepreneur's optionality condition, we take the derivative here, we can find then here our solution as, this is the price and quantity of capital, is going to be a function, or that is going to be proportional to our net worth, where we have a function here that is equal to 1 when these two returns are equal to 1, and it's increasing in the this premium, or the this external finance premium. Right, so what does this mean? The capital that we demand is going to be proportional to our net worth, and this proportion is going to be increasing in our expected discounted return to capital. So if we have an increase in this return from capital, think about the value of our net worth goes up, we can take on more debt, with a lower probability of default. Financial intermediaries are going to be willing to supply more external finance. So if you solve this for our net worth as a proportion of the capital, so maybe we have 1/4. So if we're borrowing, our total amount of capital is 4 times what we ourselves put in, and we have a leverage ratio of 4. This leverage ratio is going to be increasing in the external finance premium. Right? And so if we see the this cost here, higher amounts of capital can be financed by net worth. So this cost of funds is this risk-free rate. So we're going to be pushing up interest rates as we borrow more. Or this is the demand for capital, and this is the our demand doesn't depend on this external or the risk-free rate. Yeah, but we get a as we demand more and more capital, more and more of this needs to be financed externally, so it's going to increase the cost of our funds. And so if we look at a net worth shock, if our net worth goes up, right, then for any amount of capital, our cost of funds is lower. So in equilibrium, we're going to end up demanding more capital. So our capital increases, right? And it's symmetric if our net worth goes down. So we can think on here these balance sheets. It's like a supply shifter in the cost of funds. Net worth goes up, spreads go down, capital goes up. Net worth goes down, spreads go up, capital goes down. Net worth goes up, spreads go down, capital goes up. All right, if we take this relationship in 7 here, if we spell this out, we can write this then, this function S. If we write this function S as the inverse of this function we have here, this psi function. So this should be, yeah. And so now it's right? It's a decreasing function, so it's decreasing in our, this would be net worth, this would be inverse of the leverage ratio. In other words, it would be an increasing function of our leverage ratio. So the premium for financing capital externally is going to increase as we're more highly leveraged. Okay. So this is the key result of this underlying microfriction. We're going to take this result and now build it into a new Keynesian model. So let's first focus on a core model. There's going to be capital here, but we're going to treat the price of capital as given. We're going to have net worth being exogenous. Our capital is going to depreciate entirely within one period. Right? So maybe, I don't know, think of maybe the period is a couple of years, and our capital is a cell phone. After a couple of years, they're not good anymore. Right? They wear out quickly. Right? We're going to have to, in our model, over the standard model, is this endogenous accumulation of net worth. Right, so it's going to give us a rule for this bankruptcy probability. And we're going to have investment with capital adjustment costs. So the idea here is that there's, if you have a capital stock and you want to change it, right, if you keep your capital stock constant, maintenance is not very expensive, but if you want to install new machines, right, you have to stop production for a while, you bring the new machines in, you need to train your workers, so it's expensive to install new machines. And if you want to take out your old machines and sell them, reduce your capital stock, same thing, to stop production and take it up, and then you have to rethink your production lines, so there's going to be increasing costs for changing your capital stock. All right, now to get this key relationship of 8 that we had, the external finance premium and leverage ratio in our DSG model, we have to think of this optimal capital choice being aggregated. So we have lots of different firms there. Right? So in general, this aggregate relationship is going to depend on the distribution. Right? So we might have some really rich, some really poor firms, and the exact shape of this distribution is going to be important. But we're going to assume constant returns to scale, which is going to give us then an aggregative proportional relationship. So net worth and capital demand, right, are going to be proportional. Right? So we're not going to have to deal with firm-specific factors. Right? In that case, we take the micro-foundation result in the background, right, this costly verification, and this costly verification gives us then equation 9. Our external finance premium is the ratio of these returns, the expected risky return and the risk-free return. And this is related to our inverse leverage ratio. So our net worth, the amount of our own funds, internal funds, relative to our total lending. Right, if we take this relationship, solve it for k, right, we can invert this back again, so we have k, q, and g equals this function phi of the ratio, this external finance premium, and then log linearized around steady state, phi 0, we get that capital is equal to net worth minus the price of capital plus this term phi positive. This is going to be increasing. This is the external finance premium here. Okay. have production, again by explaining Cobb Douglas, and now we have to have capital in here. There's no reason for us otherwise to be investing. Right? We have to have this sort of capital accumulation. We're going to make it very simple at first. So standard Cobb Douglas production, alpha is capital share, and A is our exogenous technology. And then the aggregate, entrepreneur's production function, entrepreneurs have their own labor that they bring. Right? Our factory owners are working, right? And we have our factory workers. Right? They might have different elasticities of in terms of an effective measure of labor, right? But they're both static. All right. The marginal product of capital should be equal to the real return on capital. Just like the marginal product of labor should be equal to the return on labor, the real wage. Right, the marginal product of capital in period T is given by the marginal production function, the derivative with respect to KT plus 1. Right, now, our entrepreneurs, we're going to be selling our output to retailers. We're selling our transistors, and then Samsung and Huawei are going to build the cell phones. We're producing textiles, cloth, and then these final goods products, we turn them into colored shirts. So we're selling essentially the wholesale goods. Right? So we want to evaluate this at the difference between the price at the wholesale market, which is what we get as entrepreneurs, and the price of the retail goods, which is what the customers and the stores at the end face. So the relative price of wholesale goods, I just with inverse of XT, expressed in units of a capital good. Right? This is going to give us that we purchased in T. This will give us 1 over QT XT plus 1, our relative price. So our capital demand, we have our cost, the return, and here we have what gives us the marginal product, and expressed in terms of the relative price. Right, so in log linear terms, we get equation 14. Right, so what does this tell us? As this return, when this return, with more capital, we're going to be driving this return down. As output goes up, this is going to increase the return on capital. Those two should be straightforward. We have the increase in the markup of retail over wholesale. Is going to drive down this return. So the retail stores are charging more. Right? We only get the wholesale price, so relative to the price level, we're getting fewer per item. Right? This is reducing our return on our capital investment. Right? And then we have the price of capital itself, Q. As that goes up, this is reducing then the return that we get. So we fix the marginal product, and our entry price, what we pay for the capital to buy, goes up. That difference has gone down. Our labor demand, marginal product of labor, and the real wage. So we have our marginal product of labor, normal workers, and our entrepreneurs. We're going to express this as the real wage in the wholesale price. So again, just like we had here, the correct price to compare to is our own producer price. The producer price for our wholesale factories is this wholesale price. So we have the wage for our workers and our own entrepreneurial wage that we can then connect to the price level of retail price using XT, this markup. All right, if our entrepreneurial labor is inelastic, the factory manager works a fixed amount of time, set that equal to 1, normalize it, and we get our real wage is going to be proportional to our production, corrected, divided through by, right, the markup of retail over wholesale. Right, so again, think about it, we get paid in a wholesale price, even as the entrepreneur. When we go out to buy things, we have to pay the retail price. So the value of our labor, we measure relative to the retail price. Our production gives us Y, but it pays out in the wholesale price. Right, so if the retailers are charging a larger markup of the wholesale price, then this means the retail value for us of our wholesale production goes down. Right. We should see that on the right-hand side. All right, now our retail sector, each retailer is going to buy 1 unit, let's say, of this intermediate good, and is going to transform it costlessly into a differentiated good. Right, so and this is, again, it's useful to think of what this Calvin analogy is. I said that all these products are otherwise entirely identical. Right? So, we are essentially, this is what we're getting from the wholesale. The wholesale production is this. You know? And I take it and write Alex's water. Bam. It's a brand name, I'm going to charge you more. This isn't just any water, this is Alex's water. Give me 10% more. So that's literally how it works here, and that's what you want to think about, this product differentiation in all of the New Keynesian models. Right? These things are exactly identical in their fundamental productive characteristics here. Right? So we're all taking, and someone else doesn't have Alex's water, they have Wilbur's water. Okay. Right, we have some market power. I can charge a higher price, right, because it's got my name on it, and I smile when I sell it. And now we're going to introduce the sticky price component here. So these are then the same as our firms in the basic Keynesian model. Right, they're introduced here so that we can have sticky prices, right, but this capital market happens beforehand, happens separately, happens in the entrepreneur market. So then we can take the final goods perspective. So let's make a basket of all these different branded waters, all the different individual prices. We get demand functions just like we did before. And our optimal price setting problem is now to choose the price differential, the price relative to the wholesale prices. In other words, you can think of now our real revenue is the price that we choose relative to the price level times the quantity. And our costs, now we don't pay labor costs, we're just buying these blank bottles of water. Right? We buy them at the wholesale price times the quantity. So our profit is given by this price differential. Our maximization problem is going to give us then something very, very familiar. Right? Our price, we're going to aim to have it be a markup over our marginal cost, which in this case, the marginal cost of production nominally is just the wholesale price, and the real marginal cost is the wholesale price relative to the price level. Right, which is also here just the inverse of x. Right, but this is then otherwise exactly the same thing we saw on Monday. Right, if you look in the actual paper, it's a little bit different. It's the way we specified the discount factor. Again, some pricing in advance. One has to create an advance pricing. Some people have done this to try and get more this internal propagation of the model. Is it really necessary? I don't know, but you can compare this to the, actually, maybe I will, I'll go later, then when we take a break, I'll put the BTG paper up on our e-learning platform. Okay. Now in equilibrium, all retailers charge the same price, and the markup is given, so in a flexible price equilibrium, we're all going to charge the same price, and we're going to have this constant markup. Right, when we have this staggered price setting, our price level is going to be the share of firms that are stuck with the old price. Right? That is a perfectly representative sample of last period's price level, which is why we replace it with just the price level of last period. And all those prices who can't change their price charge the same price PT star. Right, so now we get them on the same steps that we did on Monday or Tuesday. We get the New Keynes and Phillips curve. The only difference now is we have this little expectational timing difference, which is just a timing assumption that the authors have made. But we have the same interpretation that we can make before. Movements in terms of our this xt is our marginal cost. We can relate this then also to the output gap, inversely as before. And so this wholesale price is the inverse of our marginal cost. Right, so if the wholesale price goes up, if wholesale prices go up, this xt goes down. That's why we have a minus sign here. And we can also relate this then to the output gap as before. If you look at them all, the households are pretty much the same. We have utility from consumption and leisure. They add in a desire for real money balances. So it's nice to take a look at to see how then you can get to a money demand function like we otherwise just assume. And that's why is it nice to hold money? I like to, money is useful to buy things, but otherwise, who cares about money? Here, under this assumption, having real money balances makes me feel good because I know I can buy something, right? You know, I'm not, I just feel happier. I don't have to actually buy coffee, just knowing that I could buy a coffee makes me feel happy. Right? It's sad when I know that I can't even buy a coffee. That feels sad. And this makes me, what does this make me? This makes me want to have some money, right? Just because who knows? Maybe I want to have some coffee during a break, and I can because I've got the cash, and that makes me feel happy, just having that money, having this option now, whether or not I actually get a coffee. They get the real wage, they get the lump sum profits from our retailers, and now they're going to save into deposits. So, utility function, log preferences. Right, this is very similar. Right, before we had the CRA, right, this is instead of a minus ht plus k to the power of 1 plus phi, we have log of, this is then log in our it's logarithmic preferences in our leisure. Right, the important thing is that we have, when we work more, right, our utility goes down. And then this is this happiness that we get from holding real money balances. our budget constraint here is expressed in real terms. So we divided everything through by the price level. So we can choose to buy, so it's the cost of everything in terms of, say, the consumption good. So if I want to buy a bond that pays out one consumption good tomorrow, well, I buy a bond of quantity of bonds equal to one consumption good today. Tomorrow, then it'll pay out RT times that, a real interest rate. So it's not done in terms of the discounting like we've done before. There's not a Q discount price here, but we now have the return, the gross return, direct in the budget constraint. Okay. Our first order conditions, we get a labor-leisure trade-off. I've seen this before. This is our Euler equation, consumption Euler equation. And this is what's going to give us then our money demand function. Right? It came from just the opportunity cost, or holding money gives us utility. Right? But holding money today means we get more resource today, but it also allows us, or costs us the interest that we otherwise could have earned across periods. So somehow our happiness, right, the amount of money that we hold is going to be such that the happiness that we get from holding it exactly compensates us for the goods that we could have purchased with the interest rate that we would have otherwise earned on the money. So imagine, the happiness that you might feel with having $100,000 in your pocket, and I can get something to eat, I can get some coffee, I'm good to go. There's something then problematic if you have maybe, $100 million in your pocket, and you just carry it around with you for weeks. Like what? That's a waste. That's a big chunk of money you could be earning interest on, right? Then it would be, you wouldn't want to demand that much money. You would get more utility if you had more than just maybe $1,000. You can't really buy much with that. So that's what equation 28 is going to do. And if you look at this, it's proportional to our transaction demand, right? And it's going to be it's going to depend negatively on our 1 minus 1 over n, so negative, negative, negative. It's going to depend negatively on the risk-free rate. It's the gross nominal interest rate, right? Because it's the nominal is the cost that you have holding money. All right. So in log linear terms, we get. Remember, we've had this equation before. We had out in front of the real interest rate 1 over sigma, right? That was this elasticity of intertemporal substitution, or sigma itself being the constant relative risk aversion. Here, it was already assumed to be equal to 1. Yeah? So that's how we get this proportional effect here. Here also remember, it's the real interest rate, so hiding behind that is the nominal interest rate for the central bank minus expected inflation. And then otherwise you'll see exactly the log linearized Euler equation that we had from one day. Okay, now our government, right, we're going to assume that we have, we're going to create money, and we're actually going to have money directly in the model, so we're going to think about what the consequences are for the government, and money creation brings the government income. Right, if we have inflation, or if you hold the price level constant, then an increase in the money supply. How does the government increase the money supply? Well, it prints the money and it brings it into circulation. How does it bring it into circulation? There are a number of ways. You can buy securities. You can buy goods directly. Right? It's going to be a source of income for the government, just like taxes. But we're going to assume that this is then done to support our interest rate rule. It's just like the Taylor rule, except we have some interest rate smoothing. So we're not going to change this nominal interest rate too quickly. We want it to be correlated. So this is also a little change to what we had in the past. Both this assumption and this expectation assumption are two little additions that Bernanke and Gilchrist put in the model to try to slow it down a little bit. Remember, we saw that based on the Keynesian model, it was completely forward-looking. Our households were entirely forward-looking, and our firms were also entirely forward-looking. So if there's anything we expected in the future, if anything future information changed, we adjusted those who could right away to that. This makes our model is adjusting too quickly to things. So let me compare with the data. Prices, inflation, and output gap tend not to jump around as much as the new Keynesian model would predict. They tend to move a little bit more slowly. Also with the nominal interest rate, this correctly. I had a different picture that was a little bit more, but that's okay. We look at the federal funds rate and the ECB rate. Okay, so kind of they're correlated together, but wait a second, how are they correlated with themselves? Is there autocorrelation here? Well, once it starts going up, it seems to go up for quite a long time, and then once it starts to go down, it seems to continue to go down for quite. This is a very highly autocorrelated process, and both of them are. This observation and one of the motivations for capturing interest rate smoothing. Right, so essentially, if the central bank sees, remember we have this Taylor principle, we need to raise a nominal interest rate more than 1-for-1 in response to inflation. If inflation goes up by 3 percentage points, we usually don't want to do a 3 percentage point jump in the nominal interest rate. We'll do a series of adjustments. too much too fast can be problematic for financial markets. People made decisions. This planning ability to, right, is very, very important. So we spread out necessary changes in the nominal interest rate over a longer period of time. And that's what we have here in equation 31. All right, so in our goods market, we now have consumption, investment. Investment today is our capital stock, which then, next period, which then depreciates completely. So this is our entire, it's the same thing as an investment today, government, and now we have a deadweight loss. Monitoring, you can think of this monitoring, we produce, yes, I mean, you know, there's a camera here that I use for fun. There's a camera there that we're using to produce the videos for the education here, so it's productive, it's entertainment. The camera that we have to use to monitor what the company is doing is not productive. The monitoring costs take up our production, and they just it's just wasted from the goods use perspective. All right, you could treat it then maybe as yeah, that's fine. All right, deposit market, the bonds that we buy, what we've been calling bonds in the past, are now going to be our deposits, right? That's going to be equal to the borrowing by our entrepreneurs. Our labor market's going to clear. We're going to equate real wage to real wage and our marginal rate of substitution. Here then the labor demand from the firms, so the marginal rate of marginal productivity. This is normal labor. And then we have this capital market equation that we had from before. And we bring these things together. There's a number of more sort of exogenous components here. In the background, we have some money supply stuff going on. But for us, the thing that we want to identify, that we want to see here, is our consumption Euler equation is the same as before. In the baseline the Keynesian model, we just had Y and C were the same, so we could replace consumption with output directly. Now we have maybe government expenditures in the background, but they're also part of output, and we have this investment. Investment depends on our net worth positively, and negatively on the cost of capital, and depends on our external finance premium that we can then reduce and relate to the marginal productivity of capital, the capital we're investing relative to the deposit cost. Yeah. New Keynesian-Phillips curve, monetary policy supply. All right, so we've added a lot of background, a lot of thinking, and we only end up really with one new equation. All right, we can go ahead and combine our consumption investment equation, the resource constraint. We're going to start to work this out, and we'll get then a net worth augmented IS curve. And if we have a net augmented IS curve, New Keynesian-Phillips curve, and monetary policy, we're going to have the same basic underlying three-equation model that we had before. Okay. But so now we want to keep in mind, or add to this mix here, something else. This net worth isn't fixed, isn't exogenously given, but it's also moving. We're going to treat it as a law of it's a law of motion. It's something that's evolving, that's accumulating, like, say, physical capital would. So our aggregate net worth is going to be the proportion of entrepreneurs who don't go bankrupt, so the survival probability times their net worth, plus the entrepreneur's earnings from work. They also get paid a wage on their factory. All right, this bankruptcy. Well, if you don't think about the micro foundation, but technically why it's important to have it here is that entrepreneurs could otherwise accumulate large enough net worth that they would get that they would become self-financing, and they would need to borrow, and we've overcome this financial friction. What's the one about that? Because what is it when everything's close, right? And then suddenly you hear sound, right? Am I going crazy, or is something happening outside? So I've got a great explanation. Do you know why the weather's bad today? Right now? Because I didn't bring my umbrella with me. So I mean, I looked this morning, it said like 25% chance of rain. I was like, nah, I'll be okay. And that's what caused the rain, I'm sure. Okay, so in each period, a share of our entrepreneurs is going to go bankrupt, and they'll consume their entire wealth. The other share is going to keep on working. They're going to add on to their net worth and contribute to 37. Right, so our equity is going to be like the return on capital times the quantity of capital we purchased minus what we had. This is minus the compensation we have to pay for borrowing. Right, so this is the outside option of the bank. Right, the bank has taken its deposits and lent it out on the market at the risk-free rate. And these are the monitoring costs that we implicitly pay as entrepreneurs. Right, and we can rearrange this a little bit and write this as would be proportional, right, sort of borrowing. So just write this as the difference between our capital and net worth. Right, so in other words, our equity is the gross returns from capital minus repayment costs of our borrowings. If you look at it in the original paper, there's some of the equations are wrong. So just a note in the original published paper. Okay. Right, now this term is the ratio of our default cost to the amount that's borrowed. Right, and this is the gives us the external finance premium. Right, it's related to. Right, so you think of we pay back not only the outside option of the bank, we pay back plus a little bit more. Right, the surplus is more than we pay is this premium, or it's related to this premium. Right, so you can see it. Here. Okay, so this net worth is going to be sensitive both to like the shifts in the capital returns. The average returns here is RTK, and then these default costs here. So we again impose this inelastic labor supply. We combine this together. We have our net worth is first conditional on us surviving. Then our net worth is equal to our net worth from the previous period minus the costs that we've had to pay the banks. And the return on our net worth from the previous period plus then our earnings from our labor supply. Right, if we're going to allow the net worth now to accumulate, let's also let capital accumulate. So before, we let delta equal to 1, and so capital completely depreciated. So if you think of this period as a couple of years, you buy one phone, use it for a couple of years, and then it's no longer any good. Did they do that on purpose? Planned obsolescence is, I think, the word. To make these devices so that they're not supposed to last too long. Right? Apple wants us to buy the iPhone 15, 27, 31, 17, right? That's the number we're on now, right? Okay. This would be the standard way of capital accumulation that you've seen, for example, like in the Solo model. Right? Capital that we use in production tomorrow is equal to the capital we have today, less depreciation, plus investment. For Navy and Gilchrist, they assume that we have marginal adjustment costs in the production of capital. So we invest I, that's what it costs us, but only this amount becomes actual gross capital. So if I is equal to K, right, then this is equal to K. But if I is greater or less than K, right, we're going to have, it's going to be costly. Right, this is with the stop production to install new machines and retrain workers and the like. So this gives us then, it's interesting then to have a time varying price of capital. Right, you could also interpret this as the productive function of capital producing firms. Right, so maybe there's entrepreneurs buy capital, this capital has to be produced. Right, an investment isn't constant returns to scale in the production of capital, right, but has increasing marginal costs. Okay. Each unit of investment is defined in terms of the goods as a cost of one. And so the cost of capital production is, right, remember we thought of the real wage over the marginal product of labor, gave us the marginal cost of production from labor. We just have the labor model. We think of marginal cost of capital production. That's going to be the cost of investment, which is 1 divided by the marginal product. Right, which is this marginal product of our adjustment cost function. All right, so we can get this down and get ourselves a time-varying price of capital, which is in the form here of equation 42. So the equilibrium price of capital equals the marginal cost of production. So QT has to be equal to this expression here. Marginal cost equals the marginal benefit, the price equals marginal cost. But if we think about the case that we had standard, when we did have these increasing costs, then this would be a constant. We'd have a constant price of capital be equal to 1. And so we see is that the cost of capital is increasing in investment, in particular increasing in investment relative to the existing capital stock. So this is adding just a little bit of, layer by layer, a little bit more complication. And so now with capital accumulation, our capital demand and supply curves have to be adjusted. Right? Our capital gain, right, is now no longer 1 over QT. Right? We now have the ability, like before, and the previous section in the baseline of the starting model, where we held the price of capital constant and capital completely appreciated, we equated then the return, the marginal cost and the marginal benefit before you just have the marginal product of capital expressed in terms of the home good. Not home good here in this case, it's the wholesale good. And now, right, we have the ability, the price of capital can change over time. Right, so we can gain a return. This is our arbitrage. We can then gain a return on capital just by holding on to it if the price increases between QT and QT plus 1. All right, so in log linear terms, we get the expression we had here. Right before we had so this term and this term. Right, so we now reduce the weight on marginal product of capital by adding here an effect of price increase in capital over time. So this is going to adjust then our equilibrium of the goods market and the capital goods market as well. Right? This is our capital demand related to net worth, cost of capital, and this external financing premium. Right? So what we see now is we have an unexpected rise in asset prices. This is going to increase net worth. If we have this QT goes up, it's going to increase our net worth, which shows up then stimulates investment right here even further. So this increase in QT plus 1 is then going to lead to an increase in net worth, increase asset prices, increase our capital accumulation. Right, putting them all together, we have then some of these other components here. We have our resource constraint, the consumption Euler equation, this capital accumulation. We now have to keep in mind, so what we have relative to the previous model, we just added the log linear one equation, one variable. Really, that's the price of capital and the effect the price of capital has on our capital accumulation. We can combine these first sets of equations to get then here an augmented IS curve. All right, it's going to depend also on our current and expected asset prices. And now we have additionally, then we have an IS, New Keynesian monetary policy, but we have some slow-moving variables in the background in our IS equation, and that's our capital. It doesn't depreciate completely, so we can accumulate capital. Our net worth isn't constant and exogenous, but there's also accumulating over time. NT. So an evolution of capital, an evolution of net worth over time. And let's take a 10-minute break, and then we can come back and then look at some of the results, and then I want to look at the computer productivity.
Yeah, every day.